Welcome to drillingcontractor.org. I'm Lauren Wolfson, and here today with me at the 2014 IADC Onshore Drilling Conference is Jim Rollison, Senior VP of Energy Equity Research at Raymond James and Associates. Thank you so much for joining me.
Sure.
So why do you think that global oil prices are structurally challenged?
Over the next couple of years, next 2 or 3 years, the main issue we're struggling with is massive U.S. oil supply growth that is something we haven't seen in the U.S. for going back to prior to 1970. It was the last time we were growing supply. And you look at the magnitude of supply growth, we think between the U.S. plus some of the other non-OPEC places around the world, we've got somewhere in the neighborhood of 2 million barrels a day of supply growth. And you contrast that with global demand growth right now that's running a little behind schedule versus what we were used to for the past decade, about 1 million barrels a day, plus or minus. And it implies you're going to continue to build inventories, which would cause prices to come down. Now, we've been thinking this for the last couple of years, and we've been basically pushed off on the timing because we continue to have disruptions in the Middle East, which in total have taken over 3 million barrels a day of supply off the market. So from the timing perspective, our best guess is it's a 2015 problem. Eventually you grow your way out of it as demand growth starts to happen at a faster pace, and supply growth is not going to maintain this pace forever. But probably for the next couple of years, absent additional supply interruptions, we're probably looking at that causing price pressure on prices.
So what is your outlook on the natural gas side?
Much better, I think, thanks to Mother Nature. We've had record winter, this year, and really caused natural gas storage here in the U.S. to be at one of the lowest levels we've seen in over a decade. And so the pressure is really going to be on to refill storage this year, and it's probably going to take prices somewhere between $4.50 and $5 in order to cause mainly coal plants to burn at a higher pace than they were last summer and cause you to free up some gas to help you get somewhere closer to full. But we don't think we're going to get back to full, and so relative to $3.75 gas last year and even lower the year before, $4.50 to $5 looks pretty good for 14. That probably continues into 2015, at least with a 4 handle, we think, on gas, and plus or minus how the weather plays out next winter.
Sure. Why do you expect 10 to 15% increase in oil field spending this year?
Well, if you look at traditionally, E&P companies tend to spend what they make in terms of cash flows. And if you look at the year-over-year price increase in natural gas, which is somewhere around 25%, plus a relatively stable oil price environment and production growth across both of those, mid-single-digit percentage growth in gas volumes this year, somewhere closer to 15% volume growth in oil, that adds up to about a 25 plus or minus percent growth in overall cash flows. And even if you account for hedging and everything else, we still think cash flows are up 20 plus percent, which leads to at least spending growth, we think, of 10 to 15%. Relative to the industry right now, thinks it's probably going to be mid to high single digits.
Well, thank you so much for joining me.
Sure.
And thank you so much for joining us on drillingcontractor.org.